what's really interesting, if you look at especially treasuries, we're now in about the third or fourth year of bear market. We had a 40-year bull market in bonds from the day I entered in the early 80s, even before I entered the brokerage business. Bonds, interest rates are 20%. We already went down all the way to 1 or 2%. That's where gold could be soft in the beginning of the year, and here's how. If we start moving in earnest towards 5% on the 10-year, the dollar is likely to strengthen on that, especially in the interest rate differential where Canada and other leading countries are cutting rates and all. And that strength in the dollar could be reasons to some people want to liquidate gold, or the shorts get more ammunition to play. That's the only way that I see gold coming down 10% or more in 2025.
Peter Grandich discusses the bond market, noting that we're in the third or fourth year of a bear market following a 40-year bull market where interest rates fell from 20% in the early 1980s to near 1%. They suggest gold could face short-term softness if the U.S. 10-year Treasury yield rises toward 5%, strengthening the dollar due to interest rate differentials as other countries cut rates. This could lead to gold liquidation or increased short selling, potentially causing a temporary 10% plus drop in gold prices in 2025. The speaker, Peter Grandich, a seasoned financial analyst, author and founder of Peter Grandich Company, highlights a shift in global metals trading, with Asia becoming the dominant center. At the same time, London and New York lose influence. This transition reduces the ability of Western markets to suppress or manipulate prices. Unlike the paper-driven trading in London and New York, Asia's market is supported by strong physical demand, leading to quicker recoveries after price drops. For example, significant declines that took months or years to recover now rebound within days or weeks. This dynamic weakens the influence of markets like COMEX, which are often criticized for manipulation. Peter also discusses potential gold price movements, noting that a retreat to $2,300 would not break the current uptrend, though they expect corrections to be limited to $100 to $150. On the upside, gold could reach $3,000, driven by psychological factors and broader participation from mainstream investors, not just gold enthusiasts. This shift in sentiment, similar to past trends with crypto and corporate bonds, is essential for reaching new highs. The speaker anticipates this change as more typical investors buy physical gold or exchange-traded funds. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
By the end of 2025, then where they start, I don't think we should look for the same type of percentage gains. It's not called to be that, and it may not be in the best interest to just go up straight up, because it could set up for a much larger correction or decline than would be necessary. But I do think it's important to understand why. And it's Monday morning quarterbacking, but it's always easier to be a Monday morning quarterback than a Sunday afternoon quarterback. So it's clear and obvious that the main thing that drove gold higher was central bank buying. And then you have the question then is, well, why were the central banks such aggressive buyers? They're doing it for absolutely a couple key reasons. One is that they recognize that there's too much debt in the world. There's going to be a tremendous restructuring someday. Paper assets, are especially in the U.S., got way overpriced, and therefore gold will serve a very useful purpose. I think that was their first thing. But I think the second thing is, particularly in certain countries, is as much as people, when Trump got elected, and all of a sudden everybody said, oh, the BRICS are dead because he said, I'm going to put tariffs. BRICS aren't dead. You'll see that come the fall. They're not going to get into a verbal battle with him right now and all, but he's going to have so much on his plate, Trump. Come next fall, I don't think the BRICS are going to be anywhere near the top of his list. But that is the reason also, because those countries and the formation of that recognize that the dollar's days are numbered. Yes, it's still the best of the worst of the currencies at the moment, but the fact of its usage continues to drop worldwide, and all the other issues they're going to face, that minimally these countries are going to set up some sort of trading system within themselves and use gold in some form to give confidence to what will be a new currency or some sort of system that they will use. I don't think they fully have made up their mind yet. They bounced around with it, but I think that's the reason. And so while I continue to expect central banks to be buyers. I don't expect them to be as aggressive as they were. And in order to propel us to the 3,000 number, which I still think is a very viable number in 2025, we're going to have to start to see some real mainstream interest come in. Because remember, we rose in 2024 with liquidating of exchange-traded funds and other things related to gold and all. And one of the main reasons for that was, and particularly in the junior mining sector, the cryptos were eating their lunch. And the crypto market has sent, there's so much money being lost. People hear about one or two that are going up. They don't know how many fail and get lost at. But the crypto market in general, I think, is way overvalued. I think this will be the year that they come back to Earth. If not back to Earth, certainly back into the orbit of Earth. And that'll help money go towards the metals. And that's what silver is going to need, Elijah. Now,
the speaker predicts that while silver may remain a secondary choice for metal investors, gold and silver are poised for strong performance in the coming year. Gold might experience some initial weakness, especially amid ongoing tariff concerns, but it is expected to surpass its current highs in the year's second half. Silver, in particular, is anticipated to break above $35 and $36 and gain momentum, potentially even outperforming gold as the year progresses into the next. Peter Grandich exposes that Asia is emerging as the dominant center for metals trading while London and New York are losing influence. This shift reduces Western markets' ability to suppress or manipulate prices. In Asia, strong physical demand drives quicker recoveries after price drops, contrasting with the paper-driven trading in the West. The speaker, Peter Grandich, suggests gold could face a potential correction, possibly retreating to $2,300 while remaining in an uptrend, though a smaller drop of $100 and $150 is more likely. On the upside, gold could reach $3,000, driven by psychological factors and increased participation from mainstream investors, such as those transitioning from crypto or corporate bonds to gold and exchange-traded funds. This broader interest is seen as crucial for achieving higher prices.
So I still think silver will still be second choice among metal investors, but I think as gold, which could start off the beginning of the year, particularly if he is going to go through with all this tariff stuff and everything, may see a little weakness. But I think as we get into the second half of the year, both silver and gold should overcome. Gold should overcome its high of this year, and silver should finally get above 35, 36 and really start to take hold. And maybe even as we get into that next year, even start to lead gold for a while. Asia is becoming the center for metals trading. Europe, and particularly London and New York, as each day goes by, is becoming less and less of a force. And with that, their ability to bring the market down and keep it down, suppress the market, manipulate it, whatever everybody wants to call, is lessening. As you see, we still have these one-day wonders. We see it wasn't too long ago, we had an $80 or $90 down day. But within a few days or no more than a few weeks, we're above where it fell from. That years ago took weeks, months, or years to do. And the reason is that in Asia, the difference is they're serious physical buyers of it, not these paper pushers that existed in London and New York. And I'm not the first to call the COMEX the CRIMEX, and I won't be the last. But the bottom line is they are not going to have the influence on the downside. Now, let me just say this, and this may send your people into a little tizzy, but not to get too concerned about it. There is the possibility, because you made a very good point, we worked for the series of higher lows. There is a possibility that gold could retreat as far back, not saying it is, 2,300 and change, and it would still be in a major uptrend. Now, of course, that would shake everybody up and all, but I don't think it will get that far. I think the worst of the correction is $100 or maybe $150 from where we are now, at worst. Not saying it's happening. The upside still looks minimally 3,000. I just think that because that's a psychological number and all. There's no meaning to it because we've never been there and all. But I think that would be a big number. But one of the things, and you will be one of the people that will be able to tell people right away, if you start to see, wow, just Joe down the street has decided to buy some physical metals. It's not my hardcore, the world is coming to an end crowd. It's the typical person that a couple of years ago was buying a crypto or some corporate bonds and now calling me up to own some gold. And they may also go through the exchange traded funds and go that way as well. But we're going to need that switch in order to get to 3,000. I think it's coming, but we need that part in order to get there.
The speaker underscores significant challenges in financial markets, from the evolving dynamics of gold and metals trading to the precarious reliance on stock market gains and unresolved economic issues like debt and inflation. These interconnected factors highlight the need for strategic planning and adaptability in an uncertain financial landscape. How might policymakers address the growing debt spiral, inflation, and economic stability implications? What strategies can investors adopt to navigate the potential stagnation or decline in stock market growth? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.